Hi, I'm Jeff from Fiber Mortgage. You may have heard that Fannie and Freddie are changing something called LLPAs. What the heck are those and how will it affect my mortgage? Well, it won't unless you're getting a conventional loan, but that's what most people are using these days. So let's start with that LLPA. It stands for Loan Level Price Adjustment. These allow lenders to bundle loans that aren't exactly the same as one another when selling them to investors. For example, someone with a lower credit score may face a charge of 50 basis points or more versus somebody with a higher credit score. This is meant to make those two mortgages exactly as valuable as each other to the investor who buys the bundle. But back up, what are basis points? A basis point, or a BIP as they're known in our industry, is 0.01% of the purchase price. So 50 basis points on a $300,000 loan would be $1,500. You'd either see this as a closing cost or in the form of a slightly higher rate. Most of the LLPAs have been in place for some time, and most of them make a lot of sense, like the example with differentiating credit scores. Those There are others, though, for loan amount, for loan to value ratio, and more. The newest changes make it less punitive for those with very low credit scores and less rewarding for those with higher credit scores. But the latest one is the most confusing of all. Let me first define an important acronym, DTI, debt to income. This is the ratio of all of your monthly debt payments against your gross monthly income. Your new mortgage will, of course, be a part of the debt side of this ratio. Your property taxes, homeowners insurance, and required association fees like a condo fee or an HOA will be there in there as well. Taxes and insurance, though, in particular, can be moving targets somewhat as the purchase proceeds toward closing. Maybe you get one insurance quote at the beginning, later on you find a better one, or you decide, to just change that up. Those things can and do change pretty regularly during the process of buying a home. So the newest LLPAs that just started to be implemented by lenders this week, that's the week of February 13th, 2023, at the direction of FHFA, the overseer of Fannie Mae and Freddie Mac, has to do with your debt to income ratio, or DTI. At face value, this actually makes a lot of sense. Someone who can easily afford the monthly payment with a low debt to income, less debt, more income, is less risky than someone who's pushing it to the limit, right? But remember when I mentioned that taxes and insurance are moving targets, especially early in the process? This means your DTI will change while your mortgage is in process. That's always been the case. But under the FHFA's new rules, that changing DTI means your rate can also change even after it's already been locked. If your rate changes, your DTI changes again. It's circular logic. If you think people are going to be confused by this, you're absolutely right. But computer programs designed to help with these calculations are potentially going to get stuck in endless loops. And that's certainly not good either. But I don't feel bad for the machines. Wow. So take a minute to digest that. If your DTI goes up a little bit because you went with a particular insurance company you really trust rather than with the less expensive option, your locked mortgage rate can actually change. Under the new rules, absolutely that can happen. It's unlikely but possible that the new higher rate could even disqualify you from the mortgage altogether. Now, of course, we'll do everything we can to help you navigate this process. If you're getting a fixed rate loan, once you've reached closing, you're still safe, even if your finances change after the fact. You change insurance companies later, your rates go up, etc. Provided you're making your payments on time, of course. Adjustable rates still follow the same rules as before after closing. So they will still adjust, but the debt to income ratio and all those other things, as they change, as your life changes, you don't have to worry about those things affecting your adjustable rate mortgage. The original rules still apply. So up until closing, though, you're going to need a team of experienced professionals on your side, that's us, to make sure that you end up with the best possible loan for your needs. Now, a little aside from my realtor friends and other industry people, this is inevitably going to cause some confusion for clients. The best tool you've got for this is a loan officer who communicates clearly and often. I will do whatever it takes to help our mutual clients through this transition period. Letting them know upfront what's going on is going to be key. We've got this. If any of you would like to talk more about this or other mortgage topics, I am happy to help. Give me a call anytime at 904 209 9287. I look forward to talking to you soon. Jeff from Fiber Mortgage, signing off.